Week 5. We're in week 5. We're in week 5. Are we in week 5? We are in week 5 of this thing. So today we're going to talk about building credit while the disputes are active. So in weeks 2, 3, and 4, we talked all about where to get your credit scores once you have your credit reports, what to do, what to dispute first, and all of those things. So now that we have the disputes in the mail, we are leading into what we should be doing while the disputes are underway, because we're not going to just be twiddling our thumbs. We want to make sure that we're using this time to be as effective as possible. So today we're going to talk about adding positive trade lines, utilizing the strategy of your credit utilization, and common mistakes that most people make when they are waiting for their scores to jump like Jordan. We want you to know that disputing negative items does not mean that you stop building positive credit. Remember, we said it kind of goes hand in hand. While you're disputing, we have to be building, okay? And so credit scores are built on two things happening at the same time in unison. So that is removing errors or outdated negatives and adding and strengthening positive payment history. Deleting bad credit helps, but adding good credit is what actually raises your scores. Adding positive trade lines the right way includes things that lenders want to see, like revolving accounts, such as credit cards. On-time payment history, we talked about before. You want to make sure that you've had at least 4 months of on-time payment before you tackle credit repair. We want to make sure that the balances are low compared to the limits, and we want to make sure we're giving lenders seasoned accounts to see and analyze. Things we want to avoid: we want to avoid credit cards that were opened in the store and that were opened too close together. So credit cards that are department store cards, that's so late 99s, that's so early 2000, right? We're in 2026, and we want to concentrate on major credit cards that you can use damn near anywhere. But you want to make sure that you're not getting into those high fee credit repair cards. You want to make sure that you're not getting a card that's secured if you happen to need that costs $300 to get the card, and then your limit is only $500. That's ridiculous. You're going to start with the bank where you bank. You're going to go there, or the credit union. It's always really good to get involved and build a relationship with a credit union. All right, so there you can they offer you secured credit cards, and typically the fees are low. And then also, we want you to avoid becoming an authorized user on someone's credit card without guidance. So we guide you here at Beyond the Home Realty. We guide you through that process. We want to make sure you understand what that looks like, and we got into that in great detail last week. The best options are going to be if you already have existing credit cards, and that's one of the first questions we ask when we onboard anyone here in credit repair. We ask if they already have credit cards that are active, because we can do a lot with those cards. Again, if you need secured cards, I would always suggest that you go to the financial institution that you already have a relationship with. And then there are credit builder loans, such as small installment loans that you can get. All right, here is an example of a mortgage-friendly credit profile. Someone that has 2 revolving cards, usually that have a utilization under 10%. So if the limit is $1,000, their balance is under $100. Someone that has 1 installment loan, like a auto loan. Even student loans count as an as an installment loan. Any account where your payment every month is the same, that's an installment loan. A mortgage friendly credit file is one that all the accounts are current. You pay all of your debts on time, and no new accounts within the last 60 to 90 days. Again, I have it down here in red. All of the payments need to be made on time. This is crucial before you go under contract and get approved for a mortgage, and then also while you are waiting to close. All right, now this is what's really gold, all right? The utilization strategy. And, the Winter Olympics are here, so I figured I'd give you a gold medal. Now, mortgage-friendly utilization targets ideally 1 to 9% usage on each card. It is acceptable to be under 30%, but your danger zone is 50%. And again, if we show mortgage lenders a good, strong credit profile, which is our goal, in order to get the lowest interest rate, in order to not be considered risky loan, then you need to make sure that your debt on your cards is under 50% utilization. So you want to pay down your balances before the statement closes, not just before the due date. Your statement balance is what gets reported. Due date just avoids late fees. So always keep that under 30% at all times, no exceptions. Ideally under 10%. Now, disputes interact with your scores because they temporarily suppress some scoring impact. That is why you cannot have any verbiage on your credit reports that state that you are disputing an account when it is time to apply for a mortgage. They want that all off because sometimes you can have a lot of accounts in dispute and it can temporarily raise your score a little bit. Lenders want to see exactly what your scores are without anything being in dispute. And what disputes do not do is they do not freeze your credit. They do not prevent positive history from reporting, and they do not replace the need for active accounts. Underwriters care more about current behavior than old mistakes. And I've said this several times over the last 4 weeks, is that they're really only concerned with looking into your financial life within the last 24 months. Now, FICO scores are forward-looking, which is why they want to see where you are within the last 24 months. Your payment history plus your utilization. Remember, payment history is 35% and utilization is 30%. So in total, payment history and utilization accounts for 65% of your score. If nothing positive is reporting, your credit scores stay where they are. They stall. So that is why it is important to, as you are getting your disputes worked through, that you are adding positive credit on top of that. Never stop all credit activity just because disputes are happening. So if you have a credit card that's not in dispute, but you're disputing other things, don't just say, I'm not going to charge on this card at all. That will not help you. Okay, you need to have some type of payment activity there. So here's some common mistakes that hurt buyers. Opening multiple accounts at once. Remember, I told you here in this credit wheel, multiple accounts at one time that are under 24 months are considered new credit, which is 10% of your credit score. Also, maxing cards out to build your credit. So I'm telling you, you need to use your cards. I'm not telling you to overuse and abuse those cards. So don't max those cards out. A mortgage lender wants to see that, oh, this person has a $10,000 credit limit, but hello, they charge $500 a month and pay it off, or they charge, or they're never over their 30%. Because what that says to a mortgage lender is this person knows how to manage their money. They know that just because they have it on a card, that they're not to go and charge everything, charge the whole damn card up. That makes no sense. So they want to see that you know how to manage your money, and maxing out cards tells them this is going to be a risky loan. Okay. Also, what can hurt buyers is closing old cards during disputes. Now, remember we said that the length of your payment history is 15% of your credit score. So if you close out your cards while you are disputing it, you remove, and in fact, you shorten the life of your credit history. All right. Also, letting cards report zero balance every month. We just talked about that in the previous slide. You want to make sure that there's some activity. I'll liken it to this. If you are wanting to lose weight, well, you just can't just be like, okay, I'm just gonna walk 10 minutes a day. Like, you have to do like things that a brisk walk, running. You have to do things that get your heart rate up. You have to do some cardio to get your heart rate up so you can get in that zone where you're starting to lose weight. So same thing with credit. You have to get in that special place that shows the credit algorithm. I'm using credit, but I'm being responsible with it. All right. If you ignore installment credit altogether, that could hurt you. So again, I said an installment loan is a loan that is exactly the same payment every month. So like the best example is a car note. But don't go out and buy a car if you don't need to, because also an installment loan is a signature loan. So if you have a loan with the bank and they gave you a signature loan and your payment is $250 a month, that is an installment account. And another thing that could possibly hurt buyers is following TikTok credit hacks. That's another story. Good credit isn't about tricks, it's about consistency. Authorized user accounts can help if the card is old, has a low balance, and reports perfectly, but the wrong authorized user can hurt you more than it can help you. We talked a little bit about that in the prior weeks. If you have someone that has a $10,000 credit limit and their balance is $9,000 and you ask them to add you as an authorized user, that's going to hurt you, because now basically you've just added $9,000 more in debt to your credit profile, right? Even though you're not technically responsible for paying that because you're just an authorized user, still they're going to see that, right? Then also, if someone adds you as an authorized user to a card and they've been late, well, then all of their pay history is going to roll over onto your credit files as well. So that's going to hurt you as well. So basically, in order to be added to someone's card as an authorized user, they basically need to have perfect payment history with that card holder, and then they need to make sure they have a balance that falls within the 10 to 30% of the limit. Okay. Now, through a Texas homebuyer lens, this is very important. This impacts your pre-approval times, your interest rates, your debt to income ratios, and your Texas property taxes, plus your payment comfort. So if you have someone to add you as an authorized user, this will be impacted, okay? Even a 20 to 40 point score increase can change your interest rate, and that impacts your monthly payment more than people realize. Again, the higher your credit score, the lower your interest, which is more home that you can afford and a lower payment. But if you're someone that says, I know I want to be at $300,000 and I don't care if they approve me at $700,000, I want to purchase a home at $300,000, stick to your guns, go for it. Don't let these people move you off your block, okay? So make sure that you understand the higher your credit score, the lower your interest and all your other fees associated with your credit, your mortgage, sorry. So that is why it is good to have good credit, because your homeowner's insurance is tied to your credit score, your homeowner's insurance, your mortgage, all of those things tie into your credit score. So the higher the better. Did you know that Texas has no state income tax? Well, we don't. But, they say what happens on one side, they're going to make up for it on the other. So we don't have a state income tax, but we do have higher property taxes than states that do have state income tax, especially on new builds and growing communities. This matters because higher taxes equal a higher monthly payment. Lenders qualify buyers on total payment, not just the principal and interest. So they qualify you based on principal, interest, taxes, and insurance. And again, your credit score impacts how much payment you can safely carry in all of those areas added together. So again, better credit equals better interest rate, better rate offsets higher property taxes, and lower debt equals more room for taxes in your payment. Everything we're covering today shows up in your mortgage approval, which is why we want to stress that we want to present the best financial picture to your mortgage lender. Building credit during disputes helps you get pre-approved faster, it helps you qualify for better interest rates, and it helps keep debt ratios lender friendly. Credit strategy isn't about perfection, it's about positioning you, and positioning you in such a way that a lender doesn't see you as a risque loan, right? They see you as someone who is financially responsible. And if I see you as financially responsible, then I don't have a problem. I don't have to second guess whether or not you're going to pay this money back on this mortgage. Now, what not to do in the window that you are planning to buy. So if you plan to buy in the next 2 to 3 months, do not open new credit. Do not close any accounts. Do not finance anything. Not furniture, not phones, not appliances, not nothing. Okay? Nothing. Your credit report needs to be stable. It doesn't need to have any movement outside of things that have already reported, right? So things that report every month. It doesn't need to see anything new. All right? And do not let balances spike, even temporarily. So going back to that example that I had, do not let your card that has $1,000 balance, for example, or $1,000 limit, do not let that spike to a $900 balance. That's throwing off your DTI, okay? Debt to income. Get a personalized readiness review by booking a consultation with me, and we go over all this again in depth, and we personalize it to where it fits your need, and you get a plan specifically customized for you. So this week's action plan, we're going to review current open accounts. This is kind of your homework that you're going to work on this week. You're going to bring balances below 30%, ideally 10%. But if 30% is where you can go, that's fine, because keep in mind, we do have to have money for your down payment. So if it's going to put you in a bind, stay under 30%. And make sure that at least one card reports a small balance. Do not open new accounts without guidance. So let's have a conversation, and let's bring the mortgage lender in on the conversation so we can make sure we're not coloring outside the lines to where you won't get approved for your mortgage. And then also, you're going to stay consistent while the disputes are processing. So everything that you've learned, all the goodness, you're going to continue to do that. We're going to continue to build the momentum while these disputes are coming in. Credit building isn't about rushing. It's about doing the right things in the right order. So today's webinar, Wednesday, is about control. Control of what I say, control of what I do. Janet Jackson. You see my Michael Jackson? It's about control and making sure that your credit activity is positioned correctly while the disputes are happening. But good credit alone doesn't buy a house. The payment has to fit your real life. That's what we're going to cover in week 6. We're going to talk about how to make the payment fit your lifestyle. So week 6 is about preparing for home ownership without sacrificing your lifestyle. This is the handout that you're going to get for today's class. But again, I think I sent it in an email. So far you should have gotten a couple of handouts. I have one for every week that we have had our Wednesday webinars. Well, I think that is it for today's class. I know it's kind of short, but listen, weeks 2, 3, and 4, we covered so much. So I didn't want to have you guys here for another hour like I did last week, because we gave out a lot of information. But this, for the most part, concludes the section regarding credit, okay? We're going to hop back on credit in 30 days when you start getting those disputes, because I want to find out if you are running into any challenges getting your disputes answered. I want to find out if you have any issues with understanding what the credit bureau's responses are. Your homework that I want you to do tonight in preparation, or this week in preparation for next week, is to determine what a comfortable monthly payment looks like for you. A comfortable monthly mortgage payment looks like for you. And then I'm going to take that information and we're going to help break that down even more, because we're going to start getting you to look at your budget. Okay. So next week, I want you to have what your monthly gross is, what all of your bills are every month, what the total of your bills are, what all of your bills are. So if in fact your Dish Network bill is $120 a month, I want you to know that. If your cell phone is $100 a month, I want you to know that and notate that on a piece of paper. You don't need to share your numbers with me, but you're going to need these numbers. All of your bills each month. And you should be able to see your bills that's reporting on your credit reports, because we've already pulled those credit reports. So I'm going to need this in two ways. I'm going to need to know all of your monthly bills that are reporting on your credit reports, and then all of your bills outside of your credit reports. So for instance, if you're paying rent now, that's not necessarily on your credit report. Your cell phone bill is not necessarily on your credit report. Your grocery, what you're going to pay every month for groceries, that's not there. But I want you to have those two lists: what's on my credit report and my true monthly payments. Okay. And then what you make every month gross. All right. We're going to talk about those numbers. We're going to need those numbers next week to help you fully dive into and get out of that week what I need you to get out of it. I want you to come out of next week knowing what your numbers are even better than what you know them to be going into week 6. So I think that is it for tonight. I appreciate you guys for being here. If you have any questions, please do not hesitate to reach out. If you think that you could possibly be ready to purchase and you need to know what's next, because we haven't gotten to that in the 52-week course, that's fine too. All of my contact information will be listed in the description of this video, so you will be able to contact me there, or you can go to my website, beyondthehomerealty.com, and schedule a consultation with me. And then that way you have taken me offline and I'm specifically concentrating on you and your file. All right. So again, if you have any questions, please do not hesitate to reach out to me, email me, text me, whatever. If you know anyone that is looking to improve their financial future, wanting to know what the home buying process is, or if they want to sell a home and buy another one, I can help. You can find all of that information here. We're building this series, and I want to be a resource for anyone that wants to find out and better their finances and find out about real estate. So until next week, remember that I am your homegirl, Daphne Brown with Beyond the Home Realty, and I am always ready and willing to enable you to find your way home. Till next week, guys. Bye-bye. Don't forget, you can always check out all the past Wednesday webinars right here in this playlist.
I'ma just lay back and crack this window.